All right, guys, we are here today. We got the FOMC meeting going live in about an hour here, chat. About 1 hour. We'll get some music playing. Let me know if you're bullish or bearish for today's FOMC stream. We are here today. Let me know how the music sounds. We should be good. We got our FOMC stream. How's the sound? We got our FOMC stream. Whew. Imagine he shocks everybody with a cut. I genuinely doubt it. Will Powell's tone be hawkish or dovish is going to be the question. All right, hawkish or dovish Powell. We're going to do a poll. All right, the poll is now live. Hawk or Dove Powell, let me know how you feel. NASDAQ is pretty great on the day. NVIDIA's been pushing up. NVIDIA interviewed Kramer earlier. And retail is all bearish right now. Machine buying is at 91%. I've been listening to some old 2000s rock, guys. Listen to the Crossfade. Again, I watched that movie Grind from like 2003. I was a skateboarder, so I watched that movie. Oh, dude, the nostalgia. It's too much sometimes, too much. I think I chose the wrong animal, couldn't see. I don't think there were. We're definitely not going to get cuts. Not today, at least. Yeah. Yeah, let me do a timer here. We got to get a timer up here. We got 2 minutes. 2 little baby minutes. Oh, look, our timer's still up from earlier. Man, I don't even have to do a timer today. We got a timer here. Chat, honestly, we're about $100 profit on the day. I don't know why it's not letting me log in. If I log in here, it boots me out. Why, dude? It's the same account. Okay, here, let me open up this on the same thing. Hold on. Alright, we just had to do it this way. Dude, it did it again. Oh, man. Okay. It's alright. We're green on the day. Guys, we are green. I hate Windows 11. I'm just saying. We are green on the day. We got bond yields on the top right. Bond yields, just to put this into perspective, bond yields here and interest rates have a positive correlation. They follow each other. They run parallel with each other. When consumers and retail have a more dovish sentiment, bond yields decrease because they follow interest rates. If interest rate sentiment is down, bond yields go down. If bond yields go up, if we have a more hawkish sentiment, bond yields increase. Today we're slightly up after dropping a lot yesterday. There's also a correlation between weakness in stocks and bond yields. They follow each other to a certain extent as well because weaker stocks make people fearful of economic recessions, and in that regard, bond yields go down as stocks go down sometimes too. So bond yields are very relevant for this report. We got the S&P 500 right here at 565. Yeah, I got on a skateboard a couple years ago. I can still double kickflip from a flat ground ollie. I can still double kickflip. I have to go find it. I don't know what happened to that video, bro. I gotta search it, dude. It's somewhere. All right, guys. NASDAQ's breaking down here. All right, let's hype up the FOMC meeting today, guys. You guys ready? Look at this picture that just popped up. Look at me. Look at that picture that popped up. Young John, beardless John. I don't know if I can even grow a beard right here. Look at that. I don't think I can even grow a beard in this picture. Beardless John. All right. All right, looking at the poll, pretty 50-50 split. 51% say Hawk, 49% say Dove. Interesting. Hey, thank you, Dan. Appreciate it, brother. Thank you, sir. Interest rates are staying the same. Yeah, interest rates aren't changing. It's not. I'm not bringing up bond yields to talk about interest rates. I'm bringing up bond yields to talk about Powell's tone. You know, everybody already knows we're gonna pause today. If whoever your guru is says that we're not gonna pause today, stop it. Okay, we're gonna pause today. What matters more so than any of that is what Jerome Powell says, what his tone is during the FOMC. That's what matters more. What his tone is during the FOMC press conference Q&A is going to matter more than anything else right now during this meeting. All right, and that's why we're watching bond yields on the top right, because they're going to be indicative of what traders digest his tone as. And so that's why, yeah. Retail bears getting clapped. Honestly, we were talking about it just now, but not a crazy shock to see the market push down some. We got the FOMC meeting going live soon. Retail option flow 70%. Tone will be C sharp. The town is. Yeah, y'all be safe. Honestly, again, do not trade during this meeting. It's kind of risky. If Powell's hawkish, it'll mean that it'll mean they've ended QT. That's something. Okay, so let me give some talking points here. To be honest, let's get some talking points during all this stuff. All right, so yeah, quantitative tightening. Let's talk about economics here for a second, guys. I don't ever drink coffee this late, but I'm sipping coffee right now, okay? So let's talk about economics here. All right. The Federal Reserve controls interest rates. They control interest rates by raising or lowering short-term rates called the federal funds rate. This is the rate everybody talks about. These are short-term rates that banks charge each other overnight. But eventually it trickles into everything else. It directly influences adjustable rate loans. That's the rates that are being adjusted, and adjustable rate loans are these. Home equity lines of credit, stuff like that. It directly influences those. It indirectly influences like mortgages and stuff like that, right? And so the Federal Reserve, their job is to keep everything balanced. They're going to keep things balanced by figuring out what the risks are in any specific economy, if this makes sense, right? If the risks are economic weakness, like losing GDP, unemployment spiking, payrolls coming in low, ultimately economic weakness, too little people working, spending, so forth and so on, the Federal Reserve will have an incentive to bring interest rates down. The reason bringing interest rates down helps is because people have cheaper access to money. Loans are cheaper, they have less interest on their loans, so they tend to spend more, buy more, businesses take out more loans and expand and all this different stuff, and it stimulates the economy in that regard. On the other side of the fear index by the Fed is inflation. It's kind of the opposite of economic weakness, although we can get it at the same time, called stagflation, but that's a different story. I'll talk about that later. On the other side of the fear index is inflation. If inflation is getting out of control, then the Federal Reserve has an incentive to raise interest rates, because it'll do the opposite of lowering them. By raising interest rates, it pushes the economy down a little bit. It makes everybody have less cheap access to money, and so in that regard, they spend less, inflation goes down. They could also do more desperate measures, like quantitative easing or quantitative tightening. In 2020, when the economy was super weak from the lockdowns and the supply chain issues and all this different stuff, the Federal Reserve stepped in and they did what's called quantitative easing. They also brought interest rates down to almost zero. And what QE is creating online bank reserves and then using those bank reserves to buy up financial assets like bonds, and it injects liquidity into those markets and ultimately stimulates the economy. That's called QE. One of the consequences of QE can be inflation. And so the Fed did that in 2020 because of all the supply chain problems. Because of those supply chain problems, and as well as the super low interest rate environment and the money printing of stimulus checks and quantitative easing, inflation spiked after 2020. In 2022, it was almost 10%. And so then the Fed raised rates for about a year and then paused rates for about a year, and what's called a hawkish Fed or restrictive Fed. And again, a Fed that's trying to push the economy down to bring inflation down. And inflation eventually slowed. But one of the things that can happen after the Fed does all that stuff and the inflation starts to slow is we can have what's called stagflation. It is a precursor to recessions, which means high inflation, still leftover high inflation from the last few years, as well as economic weakness from keeping interest rates too high for too long. A lot of people would argue we're still in stagflation, although I don't know if the inflation has been bad enough right now to say that reasonably. We'll have to wait and see. I know we see some weakness in the economy. We see lower payroll numbers right now. We see GDP going lower than it has been. We see jobless claims. Jobless claims are actually still okay. Unemployment was a little bit higher, I think, or as expected. And so we're seeing some economic weakness, but I don't know if it's enough to say that we're heading towards a recession. I don't know if we're there yet. A lot of people would think we are, and I know we've even had some like Fed Now predictions that we're going to see some really steep declines to GDP over the next half a year. And again, maybe that's true. If that's true, maybe we are starting to see, some really deep negative signs. Here's the market turning down here. But yeah, I hope all that makes sense. So right now, after 2020, and once we saw inflation spike in 2022, just to give you the context of everything, once we saw inflation spike in 2022, one of the things that happened is that the Fed said, hey, inflation's really high. We're going to do what's called quantitative tightening. Quantitative tightening is kind of the opposite of QE. It's not directly selling these bonds and other financial assets that are in the Fed's balance sheet. It's instead just letting them mature and expire, basically, and run off their balance sheet. It's called passive QT. Direct QT would be if we unload it quickly. It's a much more desperate thing. But right now we're doing what's called passive QT, and we have been for the last few years. And so one of the talking points to listen to during today's meeting is, are we going to start ending QT? And so the Federal Open Market Committee, again, is doing their two-day policy meeting, and they're concluding it today, March 19th. Investors are watching this for outcomes, especially in light of recent economic developments and policy shifts like tariffs. The federal funds rate is currently maintained at 4.25% to 4.5%. Traders anticipate 225 basis point cuts by December, with the first expected anywhere between June and July, is right now what we're looking at. The Fed has begun reducing its balance sheet by allowing up to $25 billion per month in treasuries and $35 billion in MBSs to mature without reinvestment. So again, this is QT. There is speculation that the Fed may announce a new temporary halt to this balance sheet reduction process, effectively ending QT today or now. That's something you want to pay attention to during this report. In terms of economic projections, the Fed released updated projections for GDP growth, unemployment, and inflation These forecasts are highly anticipated for today. The dot plot illustrating the FOMC members' expectation for future interest rates will be scrutinized for insight into the Fed's policy trajectory. The president's recent tariffs have also introduced obviously significant economic uncertainty that's been dragging the economy down, which we talked about some economic weakness we've been experiencing earlier. A lot of that's due to the tariffs and overall reactions to tariffs. We've seen, like, here's interest rates and bond yields. Look at this bounce right here at my support level. You love to see it, dude. I'm building confidence in my levels. Bond yields, for the most part, have fallen with the market, indicating fear in the economy. Look at this level hold. And so consumer long-term inflation expectations have gone up to 3.9%, which does complicate the Fed's efforts to maintain 2% inflation, which is why I think the Fed will be more hawkish today. But I might be wrong. Again, I might be wrong. Treasury yields have risen slightly recently, but they're down still. And yeah, we'll see what we get. Let me catch back up on the chat. I don't think we're gonna get cuts. They won't do they won't ever do stuff randomly, and we know how things are going. They want to make sure things are under control. SEC, yeah. So the SEC dropped the XRP case. They really did. That's great news. I covered that earlier. Why no cuts? Well, right now it's all about expectation. Okay, this is one of the reasons I said if your analyst thinks we're gonna cut today, they don't really know what they're talking about. Is because anybody worth their salt is gonna understand this graph right here. This is called the FOMC Fed Watch tool. Okay, this is 99% likelihood of a pause, no change. 1% chance of a cut. I would say it's less than that. I give it less than 0.5% chance of a cut today. And so it's 99-1. And so if your analyst is betting on this percentage, they don't really know what they're talking about. And Powell was not really like that in terms of his decisions. You know, you might see other people across, you know, all over. You might see like the Bank of England do a surprise cut. The Bank of Japan doing a surprise cut. Powell's not really like that. He's not really going to just rip the Band-Aid off like that. He's going to be more balanced. And that's a very big theme of Powell, is balance. So yeah, I see some people talking about Kyle. So Kyle said if Powell is hawkish, it'll mean they've ended QT and would be bullish for the market and vice versa. Wrong. Yeah, that's wrong. The reason it's wrong is because a hawkish Powell is a much more restrictive Powell. QT is a restrictive action. It is the Federal Reserve restricting liquidity from the bonds markets versus QE, which is injecting liquidity into the bond market. And so if Powell is restrictive, it means he wants to continue QT, not end it. And again, the market wants rate cuts. And so a hawkish Fed would be worse and probably make the market react negatively, but you don't really know for sure, and it's all open to speculate on. I gotta turn this music down. It's a little bit too high in my ears. Yeah, all good, Kyle. Okay, yeah, I'm seeing them saying that down. Yeah, and it's all good, Kyle. You know, again, you just had it backwards. I get it backwards sometimes. Yeah, hawkish means he's not cutting rates. He's going to be raising rates. It's a more aggressive restrict. Think about it like this. A hawk is restrictive. Claws restrict. You know, this is the easy way I remember. Dove flies. It's loose. It's happy. You know, and so a restrictive Powell is not going to... It depends. It depends. Currently, we are doing QT, quantitative tightening, which is a hawkish move by the Federal Reserve. Again, QT means that they are reducing their balance sheet through letting their maturities run off, or letting their securities run off and expire and mature. An example of this is like if I buy a 6-month Treasury bond. In 6 months, say I buy a 6-month Treasury bond. Say I buy $100,000 worth of a 6-month Treasury bond. What does that mean? They pay me 5%. So in 6 months, annualized, I'm going to earn 2.5% from that treasury bond. And in 6 months, it's going to quote unquote mature, which means I get my money back. I get my 100K back. I'm going to get 102.5 thousand back at maturity, which is the date at which your bond ends. And so by letting something mature, it's basically expiring and you get your money back and stuff like that. And so the Federal Reserve doing QT means that they're reducing their balance sheet by letting their bond holdings like expire, like run off, and they're not reinvesting back into it, which takes liquidity away. It's a move the Fed does when they're trying to push the economy down a little bit to combat inflation, if all that makes sense. We need a dovish Powell. I mean, honestly, all of this really depends on all this really depends on let's see. So I'm looking back at the economic data. So last week we had CPI show up at 2.8%, lower than expected. Last time was 3%, expected 2.9%. It showed up at 2.8% year over year, better than expected. Core CPI showed up at 0.2 versus 0.3%, lower than expected, lower than last time as well. Core CPI year over year showed up at 3.1% versus 3.2% and 3.3% last time, lower than expected as well. Base consumer price index month over month showed up at 0.2% versus 0.3% and 0.5% last time, lower than expected as well as lower than last time as well. So the last few CPI readings were better than expected, just to put this into context. But the Fed actually uses something called PCE. And so the last PCE reading, let me make sure, for January showed up at 2.5%. 2.5%. PCE shows up next month too. So last January showed up at 2.5%. I want to see what the core reading was. And so again, just to put this in perspective, here's the look at the Fed's preferred inflation metric and how inflation is getting somewhat better. And so maybe the Fed will be dovish today. It doesn't necessarily mean that, but here's the last PCE graph. Inflation is decreasing, slowing is the better word for it. So we are seeing slowing inflation leading up to everything. But with the last reading again showing up, core PCE showed up at about 2.6%. Or no, it was like 2.6 or 2.8%. So we are seeing decreases to core PCE inflation. But we're also seeing, so something we're seeing right now is we're seeing economic weakness as well. Last non-farm payroll report was weak. PPI also showed up lower than expected, showed up at 0% month over month. And then we got GDP next month, PCE. I think payroll showed up at like 70K last time as well here. So somebody told me I look like William Dafoe. Bro, I'm just going to add that to the list of people who they say I look like. Do I look like William Dafoe? Hopefully not William Dafoe from Boondock Saints. Yeah, we got 37 minutes left. No way, Defoe. I don't see it. Yeah, and somebody told me I look like American Sniper, and I thought they meant Bradley Cooper. I'm just now realizing I looked up what the actual American Sniper looked like. They were talking about him because I do kind of look like him. Look, hold on. I mean, I'm under the impression that this guy was full of crap, personally. Like, rest in peace to the guy, but like, I'm pretty sure he was lying. Because I can kind of see this guy. I'm definitely a more handsome version, you know? But they were talking about this guy. right? This is the guy that we're talking about. I see it. I guess I see it. Yeah, look. Ryan Felipe? I've heard that one before a lot. I know it hurt. It hurt a little bit right here in my chest, man. They were like, you look like William Dafoe. I'm just like, man, dude, it hurts. It hurts right here. I mean, if I didn't know I was like super attractive and handsome, it hurt more, but it still hurt a little bit. And so I don't really appreciate it, but you know. I'm the Temu version of that guy. Hey, it's all right. It's all right. You think we're going to do 25 basis points, UB? Oh, thank you, Don. I appreciate you coming to my defense like that, brother. I appreciate it, Don. That guy saying he needs to get his eye checked. Listen, I appreciate it. I know I need the validation, guys. I need you guys to just tell me it. Yeah, I'm watching the market down. Honestly, we're testing 810 here over and over and over again. So we're testing 810 here. Honestly, this was the first day that I really started trading the system that I talked about this morning, and I'll explain it this morning. I'll explain it, but I'm using levels, documenting levels. If it's the first time we test these levels in in over 20 minutes, I attack the level. Meaning like if we hit this level here, I buy it right here within a range and then look for a small scalp up and then get in and out. And then if it's a retest of said level, I do not attack it like this. Retest of it, you know, because then we kind of break. A lot of the time we break. Like how often do you see something move down, bounce off of one of my levels and then dump down here like this, right? I don't want to get stuck in this if I'm going long. You know, you could also attack it on the retest on the opposite side, but again, then you're going to get situations like it just did where it bounced directly off of it and continues holding and it kind of chops sideways. And so I think the way I have it works the best. If it's on the long side, it would look something like this or if it's on the short side, we go up to this level, we short it here, we attack the range, and then we get out. If it goes like this and retests it, we definitely get out because we don't want to see it rip back up. And that honestly worked pretty well today. Let me see what my accuracy and all that stuff is today. Hold on. Let me see what my accuracy is. So we are running 70% accuracy, 11 and 5. So we made money on 11 out of 16 trades, about 70%. Profit factor of 5.32 to 1. Average win is about 2 to 3x larger than our average loss. So pretty good. I'll take it. Green is good. But that's day one, and then again we are on a 4-day green streak. And again, the weird thing about today's FOMC meeting is that I think we could really argue either side. I think we could argue hawkish Powell. I think we could argue dovish Powell. I think Powell can honestly come in either way, and I think both sides make sense. You know, again, inflation has gotten better over the past 2 years, right? It's not 10% anymore, but we're still dealing with that 10% spike, which is a lot of it was due to economic stimulus, like again, QE, stimulus checks, supply chain restraints from 2020. A lot of the world is still dealing with that type of inflation. You know, even if inflation has slowed since then, prices don't really go back down unless we enter a deep recession or depression. And again, guys, this is why I don't attack retests. Right here. Look at this. And so it's one of those things where, here, look. It's one of those things where I think Powell could argue either side. You know, that's an argument against cuts, is restrictive Powell. You know, we've seen a lot of different forecasts saying that we're going to enter a recession this year or next year. And so a lot of people are talking about it in that regard. And again, we'll see what happens. But I think that obviously is an argument against rate cuts. Or no, I think that obviously is an argument for rate cuts. I mean, the fact that we might enter a recession or depression, that's an argument for rate cuts. And so I think we're in this really sticky spot where Powell is either going to be hawkish or he's going to be balanced. I don't think we're going to cut rates. I don't think he's going to move the expectation of cuts up either. But I don't think he's going to be incredibly hawkish. I think he's going to be more hawkish than dovish. But I don't think he can be hawkish because I think that's going to cause even more of a negative response in the economy. So, yeah. All right, guys. So we're starting to push down here. Didn't we have some type of Fed Now report yesterday? Yeah. Honestly, the Fed Now report came in better than expected. So it was expected at minus 2.1% for this first quarter GDP. So the Fed Now GDP that showed up yesterday, it showed up at 1230. They expected a drop of 2.1% this year, or this quarter one, and instead it's only 1.8%. So it's actually a little bit better than expected. So again, that honestly is a hawkish argument. Canelo Alvarez. Powell's not really allowed to invest. I think it's important to understand that no matter what happens during this FOMC meeting, it won't change the fact that John Jones saying he needs 6 months to prep for Tom Aspinall is absurd. Listen, bro, I agree. I like John Jones. He's the greatest of all time. Middleweight, at least. Or light heavyweight, at least. Greatest of all time. Coming from the worst blue belt in jiu-jitsu, John Jones is the light heavyweight GOAT. All right? But he's definitely ducking Aspinall. Let's all be honest here for a second. Aspinall's a risk. Jones is old. His chin's going a little bit. He's looking a little thick lately. He's definitely ducking Aspinall 100%. I think everybody knows he is, too. He doesn't want to fight Aspinall. I wouldn't either if I was him. He's still the GOAT, but, you know, I wouldn't want to fight Tom either, all honesty. So Tammy, Bertha, and Joby are all fake. Are you really spinning your life, brother? Something just tells me that you're spending your life creating multiple fake accounts to troll me during an FOMC stream. Is that right, dude? I mean, live your life, brother. Let it out. I'm not sure what you're trying to accomplish with it, but listen, I'm not judging either. Live your life, dude. It's all engagement. I appreciate you being here. Yeah, Dominic Reyes beat Jones. It doesn't matter, though. You got to take out the champ. It doesn't matter. Unless you're Alex P. All right, guys. So we bounced right at the 78 level. Look at that hold. Now we're testing this previous 810 level, breaking right over it. Again, we did break under the 200 exponential moving average. Powell is ducking John. Listen, I'm for it, Femi. Pay Jones. You know, I think 30 million's a little steep, though. You know, but maybe that's just Jones' starting number, and he'll go down to 15. 15 million's fine. This is my favorite trade channel. All real. No copium. Thank you, Pasta. Appreciate it, brother. Thank you, sir. I didn't say anything about haters. I told him to live his life. Listen, I get it. Data earns billions. All right, guys, we still got 25 minutes before the rate decision comes out. 25 minutes. We got almost 2,000 here already. What do you think is going to happen with gold? Oof. I don't know. Gold's at all-time highs. It's been up there. New all-time highs on gold are just over 3,000. We're at 3,040. All-time highs are 3,050. We'll see. I know, Femi. Listen, it's okay, bro. Listen, I get it. Honestly, again, I'm not even saying Jones is the GOAT. Again, you have some people that act like Jones is not the greatest MMA fighter of all time. Definitely light heavyweight. I think Jones is the greatest. I just want to see that fight. And I'm a little disappointed Jones isn't taking it. But I also understand. And here's my problem with Jones. Is that when Jones got his belt, he got it from an old Shogun Hua who gave him an opportunity. Old Shogun Hua gave Jones an opportunity. And Jones took it and got the belt. Jones is unwilling to give a young Tom Aspinall the same opportunity that Shogun gave him. That's my issue with Jones. And everybody knows this is true. And so, you know, if you're going to do that to other people, bro, you got to be willing to put it on the line for others. Market's bouncing back up, though. We're at 830s. We got Jerome Powell today. Jerome Powell, again, the big thing is we're going to see what he says. But at the same time, I also understand Jones not doing it. Anyways, we're bouncing up. Here's the 200 exponential at 840s. Again, we're watching bond yields. Here's gold if you want to see where gold is at. Again, most people think Powell is hawkish. 56% of the poll. We got about 1,300 votes. 56% of the poll think Powell's going to be hawkish. Again, some things to pay attention to. The federal funds rate is currently 425 to 450. Traders anticipate at least 2 25 basis point cuts by December, with the first expected anywhere between June and July is the current expectation for rates this year. Paying attention to quantitative tightening. Paying attention to QT is important because the Fed's been doing QT for a minute now. Growth, the Fed releases updated projections for GDP growth. We got tariff news tanking the markets recently, and so that's important to watch. Inflation expectations have been kind of mixed. Again, we got Powell today. Again, the Fed 4.25 to 4.5%. Here's a good question. What will rates be by October? What will rates be in October? Will they start cutting in July or June and keep cutting? Or will they only cut once and then pause? Big question. Looking at our reactions here. October rate will be 0, 2 to 3 cuts for sure. So is a rate cut bullish for markets? My bad. I'm new. Probably, but it's never 100%. A rate cut is probably bullish. The market wants rate cuts. Rate cuts stimulate the economy in a more profound way. But sometimes the market is a little bit more variance heavy. What is the chance of cuts right now? It's 99 to 1% chance of a cut. Most people right now think the market is going to... And again, if you want a full breakdown of all the stuff to watch for during today's FOMC meeting, here is something to watch. on our X page. Give me a follow there if you want. But again, looking at the rate expectations as of now here, most people expect a cut by July. Here's June. June, 51% chance of a cut down to, let me make sure you guys can see this. Yeah, so by June, 51.1% chance of a cut down to 4 to 4.25. May, 16% chance of a cut by May. Unlikely though. July, 48% chance of a cut by June or July. September, you know, still pretty mixed. So basically by September, they think most people think we're going to cut rates just once for 25 basis points. About 37% of people. 36% of people think we're going to do 2 cuts, or at least 2 cuts, or 2 cuts of 25 or 1 cut of 50. By October, most people think we're going to have 50 basis points retracement in interest rates by October at about 37%, 36.5%. So that is the current expectation for rates right now. Today, they're pretty overwhelmingly expecting a pause. It's also possible we don't cut rates. It depends on what inflation shows up as. If inflation spikes from now to then, anytime, if inflation spikes next week for PCE, that's a risk. If inflation spikes next week for, what is next week expected here? So next week we're expecting PCE. We don't have the expectations yet. Last time PCE came in at 2.6% for core PCE. Regular PCE came in at 2.5%. And this is the Fed's preferred inflation metric. It drops next Friday. We will stream the entire thing completely live right here. Don't go anywhere. Markets are bouncing back here. SPY is bouncing back. A lot of the time ahead of these meetings, we get choppiness. We get sideways neutral activity. Looking at our poll now, we asked people, will Powell's tone be hawkish or dovish? 56% are hawkish, 44% are dovish. Looks like I messed up the poll. We're definitely not cutting today. We're 99 to 1%. When we're probably going to cut is July, June. CPI below 2% by May? I don't think so. Rate cuts imply weaker economy and weaker corporate profit. Right, exactly. Lower interest rates can spike inflation. The Fed's going to be much more apprehensive to lower interest rates earlier than later just because of inflation worries. The big story of today, I think, is QT. 1 rate cut expected win. He's got to be dovish because the economic numbers are heading south. Yeah, I mean, that's definitely possible. He can certainly be hawkish, dovish. I think both arguments make sense. I think payroll numbers last time showed up at about 77, 75, 70 something. What were they? What were the last payroll numbers, chat? Let me look this up. It wasn't last week. It was the week before. Payroll numbers showed up. At 151,000 versus 159,000 expected. So the last payroll numbers actually showed up at 151 versus 160 expected. Previously, before that, they were like 70 versus 140. So payroll numbers have been low. GDP forecasts are lower. Again, payroll's low. GDP forecasts have been lower. Inflation is still a little icky, I think, and people are nervous about it. And so that's the dovish argument. The hawkish argument is inflation is sticky and you know, they don't want to bring interest rates down unless there's a justifiable reason. All right, so look at us reject here. We had this 850 level drawn on our chart. Look at the 200 EMA 850 level, and now we're rejecting back down some. Yeah, I think the big story of today is QT. Will the Fed do QT? Will they do quantitative tightening still? Will they end QT like they're talking about? Again, just to put this into perspective, the Fed has been reducing its balance sheet and doing QT for a while now by allowing up to $25 billion per month in treasuries and $35 billion in MBSs, which are mortgage-backed securities, to mature without reinvesting it, which is QT. It's letting them run off and mature off their balance sheet. There's speculation that the Fed may announce a temporary halt to this QT. Will they end QT? That's the question. for now. You know, they might end it and then start it back up. And so that's what I'm listening for today. So ending QT would be a dovish thing by the Fed. Would be a dovish thing, ending QT. Quantitative tightening is a hawkish stance. It would be a dovish thing if they end QT. What color will Powell's tie be? I'm going to go with purple. I'm an LSU fan, and so I believe Powell is too, deep down inside. LSU baseball is going on right now. I'm an LSU fan. I believe Powell is too. He's going to wear a purple tie today, I think. Put that out in the world. So, Shank, today the Federal Reserve is not going to change interest rates at all. You can look at something like the CME Fed Watch tool to see what the rates are going to be most likely. Right now, it's less than 99 to 1. It's more than 99 to 1% likelihood that we're going to pause rates and we're not going to change them today. And so that's overwhelmingly expected. And it's not about predicting what the Fed is going to do today, because that's what they're going to do. They're going to pause rates almost certainly. Not an investment professional. I'm not liable if you lose. I have no freaking idea what I'm talking about. But it's not about what their rate decision is going to be today, because everybody already knows they're going to pause rates today. What it more so is going to be about is what Powell's tone, meaning is Powell hawkish, meaning restrictive in his tone? Does he want to push the economy down and be restrictive to combat inflation? Or does he want to be dovish, which means bring interest rates down, be less restrictive, stimulate the economy more to save us from a weak economy? You know, the market tends to want that, the latter, which means they want Powell to be loose, less restrictive, more dovish, lowering interest rates earlier than expected. You know, inflation expectations are important because of this. That's probably what the market wants. But argument's sake, a lot of people are going to argue he should be more hawkish and push back raising interest rates even more. I don't know. We're seeing some stuff like the Fed now. GDP came in at 1.8% weakness for quarter one. If that's true, he might be more dovish than expected and want lower interest rates earlier because of economic weakness and GDP weakness. That's possible too. Or we could have inflation fearing Powell, and Powell comes out fearing inflation and wants to continue doing QT and, you know, push back rate cuts to even further past July. Either of those things can happen, and they're going to make the market react either way. And so that's what you want to tune in here for, is because we're going to cover what happens. We're going to cover everything that goes on. We're going to cover what Powell decides to do, what his tone is like, what the rate decision is. The rate decision drops at 2 p.m. Eastern Standard Time in 12 minutes. So that's what's coming out in 12 minutes. The accompanying press conference is at 12:30. Subscribe to chat. We're going to put this up here. All right, guys, 11 minutes. Fed follows the 2-year. Yeah. You guys ready? All right, so market's still consolidating sideways. Yeah, so we're looking. All right, so we're gonna look at. Yeah, I know the Fed likes to use this one here, which is the 2-year Treasury, or and you can kind of see it here. But these are the bond prices, so this is actually going to go inverse. So if this goes up, it means interest rate sentiment is down. You know, so like if this goes down, this means interest rate sentiment is higher. I like to watch the 10-year because they're close enough and it gives you the same thing, but I can follow interest rates in this way. If this goes up, interest rate sentiment is higher. If this goes down, interest rate sentiment is lower. All right, we got about 3,000 viewers here. We still got 8 minutes left. Chat, 8 minutes left. Powell did a good job stabilizing the economy, but those tariffs will ruin all the progress. Will throw us into a recession? Maybe. What's the most people you had on your channel at once? I had about 14,000 for NVIDIA earnings a couple years ago. Like their first big earnings. It was 14,000, but or something like that. Yeah, we're going to stream the whole Powell speech as well. You can read it right here. So we're going to stream the full Powell speech, the full conference live. Let's make a bet then. Make a bet on what? I don't even know what a bet is, bro. What's a bet? On a crash? I mean, I tend to think Powell's going to be a little bit more hawkish and the market's not going to like that. That's too political, R. I'm not really going to get into that, dude. Is this a do or die moment? I don't think so. I mean, honestly, guys, like, look, I'm gonna be just real with you guys. It's in my best interest to hype this up and make it seem like this is the biggest FOMC meeting of all time. Realistically, we're gonna pause rates today. Everybody already knows this. What Powell says is probably gonna be incredibly balanced. Market, regardless of this, could react good, could react bad. If Powell comes out more hawkish than expected, I think the market's coming down. If he pushes back interest rate projections, I think market's coming down. If he pushes up interest rate projections, market's going up. If he thinks inflation is under control and that means more justification in cutting rates, market might go up. Nobody freaking knows unless you got insider info. You know, a lot of people think the market crashes every FOMC. It doesn't. Sometimes it does. It certainly could. Doesn't mean it will. And so again, pay attention to interest rate projections, what the base case is for inflation expectations, quantitative tightening, interest rate projection. We're going to stream it all live here. I'm also going to turn the volume up to make sure you can really hear this during the speech. So stick around. We got 6 minutes left. 6 minutes. All right, you guys ready? We got 3,000 viewers here. We still got over 5 minutes left. Buy or sell right now, chat. Again, I'm going to preface this with I am not an investment professional. I have no freaking idea what I'm talking about. I might be wildly wrong about anything and everything I say. Understand CFTC 4.41. Hypothetical or simulated performance have limitations, guys. I have no freaking idea what I'm talking about. We got 5 minutes left. 5 minutes left, chat. 10-year yields are spiking. Yields and interest rates tend to follow each other. And so with yields spiking, it means interest rate sentiment is higher. Although interest rate sentiment is down over the last 3 weeks, 4 weeks since we started this correction in markets. The SPY is pretty much flat since the opening bell, right around flat. The NASDAQ has been decreasing, but it was up on the day, so it's pretty much flat on the day as well here for the NQ. And again, in 4.5 minutes, we are going to have Powell. Here, this timer's a little bit late. Let me fix it. All right, guys, we got a little bit over 4 minutes left. Buy, get ready, long. All right, so here's a more accurate timer. There's a more accurate timer right here. Sell the news, big crash coming. Maybe, I don't know. World circumstances need us to pause domestic circumstances that are 100% self-inflicted because rates. Yeah, I mean, the tariff news, here's the thing. The tariffs going on over the last couple months here in the U.S. are more of an argument for a dovish Fed. Why? Because the tariffs, honestly, they could go either way. Tariffs can make inflation worse. They can also cause drastic economic weakness. And so that kind of contradicts the rate situation here. You know, if tariffs make inflation worse, it means we need to cut rates less, because cutting rates lower might make inflation even worse following it. If tariffs make the economy weak, which a lot of people are projecting as well, then that's more of an argument for rate cuts. And so we're in this really weird spot. Powell's going to have a purple tie because, again, deep down, Powell is an LSU fan, guys. Here we go. What color will Powell's tie be? Let me know. I like this live show. So exciting. Hey, thank you, man. Boo. Big O, boo. Go Tigers. Get out of here. I'm just joking. Stay. Watch. But go Tigers. All right, guys. We got 2.5 minutes left. Here, I'll put the Q up here on the... this is the Q. The NASDAQ 100. This NQ right here. This is the Q. This is what the Q tracks. Is the NASDAQ futures contract, which is right here in the middle. Oh, on the left side. This is the Q. Price action. Here we got bond yields. All right, here, let's get some scary music coming in. All right, guys, we got 1.5 minutes left. What is Powell going to do? Powell. Okay, this is better. Powell. 1 minute, guys. 1 minute, 10 seconds. Listen, hit the live button next to the play button. Make sure you're fully caught up on stream. I appreciate it. Hit the live button next to the play button. Make sure you're fully caught up on stream here. Here we go. Almost here. We're almost here, guys. Less than a minute. Less than a minute. Forty seconds. 40 seconds. Forty seconds. Five, 4, 3, 2, 1. And here's the release. All right, market originally reacted. Again, the Fed paused. Fed paused interest rates, but again, that's what happened. The Fed paused interest rates. Not a shock. Fed paused interest rates. Market's reacting positively to it, going up a little bit here. Again, we'll see if we get the actual report. Market is going up, though, but the Fed paused. Rates left unchanged as expected. Fed says will slow balance sheet runoff process, also expected. Again, we'll put this up on screen so you guys can see it. Market is reacting favorably to this report. We'll see if we can read the actual statement here. Be ready. All right, so recent indicators suggest that the economy has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainties around the economic outlook has increased. The committee is attentive to the risks and both the upside of its dual mandate. In support of this, they decided to keep the federal funds rate at 4.25% to 4.5%. And considering the extent and timing of additional adjustments to the target range for the Fed rate, the committee will carefully assess incoming data, evolving outlook, and the balance of risk. The committee will continue reducing its holdings of Treasury securities and agency debt and agency MBSs. Beginning in April, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from 25 to 5. The committee will maintain the monthly redemption cap on agency debt and agency MBSs at $35 billion. They're strongly committed to supporting maximum employment and returning inflation to 2%. All right, guys. So the Fed paused. Okay, what all of this means is that they're going to slow how much they're doing QT. Okay, they're not ending QT, but they're slowing their QT down a little bit, which is a more dovish stance. Again, they're not ending QT. They're still going to be doing $5 billion monthly redemption cap on Treasury securities, which was $25 billion. So they're reducing it 80%. They're 80% reduction in Treasury security QT. They're still going to maintain the monthly redemption cap on agency debt and agency MBSs at $35 billion. So they're not ending QT completely, but they're definitely slowing it down a little bit, which is a more dovish thing. It's probably why the market reacted positively to this report. And we do have the FOMC meeting coming very soon. So we do have the FOMC meeting showing up pretty soon here, guys. And again, we are going to stream the entire meeting live right here. Again, we are going to stream the entire thing live right here. And yeah. All right, guys. So again, basically what they said was they're keeping rates the same. They're starting to slow QT. Yeah, they're bringing it down from 25 billion cap down to 5 billion. Keeping MBS. They're going to be keeping MBS redemption cap the same. All right, guys. So yeah, we're gonna. Yeah, so we're gonna post this on our X page as well. And again, we are gonna stream the full meeting going live here. All right. And again, stick around. We are going to cover everything here. Market is mostly unchanged. Remember the people that said the market was going to crash? Where, oh, where have you guys gone? What happened? Guys, where are you guys at? I thought we were going to crash right now. Where'd it go? Still early, I guess. Yeah, so again, we are going to be doing the full press conference live here. So again, we will be watching the entire thing completely live as it happens. It's not the end of the day yet. The cap decreased 80%, Will. And so again, the committee will maintain monthly redemption cap on agency debt and MBSs at $35 billion. Starting in April, this is. So starting in April, the committee will slow the pace of decline of its S securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. That's an 80% decrease. They're going to maintain the monthly redemption cap on agency debt and agency MBSs. So that's what happened. Hope that makes sense. Guys, yeah, we are going to stream the entire FOMC conference right now. Market's starting to turn. I got to go see if Jerome Powell's outside. Guys, so yeah, let me know what Powell's tone is going to be like, whether you guys think Powell is going to have a hawkish tone, a dovish tone. Whew. All right. No, I'm here. I had to go see if Jerome Powell was coming at the door. All right, guys, market's bouncing back pretty unchanged here. We got the Federal Reserve press conference coming live. We'll put a timer up at about 23 minutes. 23 minutes. Again, 23 minutes. We got a timer up. 22 minutes, really. Here's the timer right here. Blast it. Spit on that thing. What color is Powell's tie going to be? Honestly, look at the interest rate sentiment. So here's bond yields, right? So again, if you want to know the logic of the Federal Reserve here, here's Treasury yields. Why did these decrease? And why did the underlying bond prices increase? You can see like ZT, which is 2-year, go up. Why did this happen? This happened because interest rates and yields follow each other. Yields are down from the report, dropping right here. Why are yields down? Because they're going to be slowing QT down. They're going to be slowing QT down starting in April. And in that regard, bond yields are reacting in a favorable way. And not bond yields favorably, but interest rates are reacting favorably, which means interest rates are going down. Potentially, it's a more dovish thing. Ending QT or decreasing QT to that extent is a much more dovish thing. It's a much less restrictive thing. And so less restrictive means what? Lower interest rate potentially. Bond yields are decreasing from it. Market's going up because of it as well. That's the logic of this here, if that makes sense. Okay. Should I change the music? I had the scary music play. Is that a wolf? Is that outside? They got a jazz section here. All right, guys, market. Calls are juicy. Can John pronounce mauve properly? Was that it? Is it mauve? Yeah, rates are unchanged. Here, let me put the data up here. Rates are unchanged. Yeah. Rates are unchanged. That's what this is. Again, so here's the split. We'll put this up on chat. There you go. 4 1/4, 4 1/2 as expected. 11-1 vote split. Waller voted unchanged. All right, Powell. Again, speaking soon. Guys, we got 19 minutes, 18 minutes. The Nasdaq's mostly reacted favorably to this. Look at the Nasdaq pop here. All right, guys, rates are unchanged. Dovish Powell potentially ending QT. We'll see what that means moving forward. All right, market's pushing up. It's at 19.9s here. 19.9s. I found nothing dovish in that report. I mean, you don't think slowing down quantitative tightening is a dovish stance? They're reducing the cap on it from, what was it, 25 billion to 5 billion. That's an 80% reduction in the quantitative tightening starting in April, which is next month. That's pretty dovish action by the Fed. You know, they could have just kept QT rolling, and I would think there's some arguments to keep QT rolling, especially in terms of how much inflation has gotten bad over the last few years, over the last 5 years. There's a lot of arguments to keep QT rolling as it was, but they're reducing it. And so, I mean, I think that's a very dovish stance, you know, personally. I mean, and if you don't think that's true, again, I'll listen to the argument. I'm open to hearing it. Maybe I'm wrong, but it seems pretty dovish to me. And the market probably reacting favorably to it. We could see interest rates going down as well because of the more dovish lower interest rate sentiment here from it as well. So I think all of that makes sense so far. It's kind of dovish, but people expected a complete stop of QT. I get it. But I also think QT is a good balancing point. I think keeping rates low or pausing rates but continuing to QT roll makes a lot of sense in balance terms, right? I mean, it's not going to make a lot of sense if we in QT pause or in QT and do rate cuts. It might be too dovish, might spike inflation. So I think there's a lot of arguments for, you know, keeping a little bit of it going here, and I think the market tends to like it regardless of anything. Malf. QT is quantitative tightening. It's the Fed taking liquidity away from the bonds markets, reducing liquidity. It's a more restrictive stance, pushes the economy down a little bit to combat inflation, is what QT is. They've been doing QT since inflation spiked in 2022. Inflation spiked in 2022. The Fed pivoted, started raising rates and doing quantitative tightening, which again is reducing their holdings of Treasury securities to push the economy down a little bit is the reason they do it. And this is a restrictive action by the Fed. Its purpose is to restrict the economy to combat inflation, because the less people spend, the better inflation gets. And so again, the rumor prior to this event was that they were going to completely end QT. It's looking like now the Fed is going to be continuing it, but at much slower pace. You know, the problem that we get from a lot of these FOMC meetings is this, right? Is that, like, rookie traders that think the market crashes every single FOMC meeting, for whatever reason, they get really emotional about it, right? So, like, they tell everybody the market's going to crash. When the market doesn't crash, they start just whining. They just start, oh, we should have done this. Market's going down. You know, at a certain point, you got to just tune it out. Because, again, the market's not... If the market crashed during every FOMC meeting, everybody would be freaking rich. I would just short at every FOMC meeting. I cover every single FOMC meeting. Market crashes, I don't even know. Market crashes, almost none of them. Market goes down, and I would say maybe 10, 15, 20% of them. Maybe. And when I say down, I mean like a large percentage down. Sometimes we close red, sometimes we close green, but it's not something that happens every time. And it's certainly going to be less likely to happen now whenever the rate cut is overwhelmingly expected. You know, what does that mean? Everybody expected a pause today. And so what does that mean? That means that the outcome of a pause was baked into this report. So everybody that thought that we would pause, which is basically everybody, had already taken the positions that they wanted from this report. The times in which the market crashes are usually where the rate decision is a little more polarized, right? Meaning sometimes 60% want a pause, 60% want a cut. And if we do something there, it sways it a little bit more. It moves markets a little bit more because it's more of a shocking outcome versus something overwhelmingly expected like today. And so the people predicting some wild crash today, again, I'm not saying y'all are rookies, but yeah, we're not going to crash after every FOMC meeting. It's not a reasonable expectation here. I'm not angry. I'm happy, dude. I got 4,000 people watching me right now. I'm pretty happy. Yeah, just don't be so emotional about FOMC meetings here, guys. Come on now. Honestly, it's still a little early. And so we might, I mean, listen, we still got the press conference. The press conference, to be fair, let me back up the other way here for a second. To be fair, it's certainly possible Powell says something retail doesn't like and the market goes down from this FOMC conference. Certainly possible. If Powell comes out really hawkish, pivoting away from the dovish mindset that slowing QT is, if Powell comes out hawkish, maybe the market does come down during this FOMC conference. We'll have to wait 13 minutes to see. I'll be here. What color will Powell's tie be? That's all I care about. Again, you see bond yields decreasing, indicating a lower interest rate sentiment because of the slowing of QT. You see bond yields decrease here. These follow interest rates. 10-year TNX follows interest rates. You see them decreasing from this report. I see somebody complaining that I'm not trading. Honestly, bro, who is trading right now? Who's going to trade this? No experienced trader should be trading this stuff, dude. If I trade, I'm trading very small size. And I'm already green on the day. I'm on like a 4 or 5 day green streak in an account that I'm very green on. Now ain't the time, brother. Now ain't the time. I'm not judging if you trade, but don't shame me if I don't trade. Gold right now? What's gold doing? I'm curious to see what it's doing here. Gold's pumping up. Gold's about to break all-time highs if it breaks 3050s. Which I believe is the... Yeah, gold's getting very close to all-time highs here. Let's put gold up on screen for a second. Again, I hear a lot of people asking questions. Let's do a quick economic recap. I'll teach you economic policy in about 5 minutes. Stick around. Listen. If you want to understand all this stuff, if you don't understand it, let's talk about it, okay? The Federal Reserve, their job is to maintain interest rates in a balanced way. If their fear is economic weakness like recessions, depressions, losing GDP, high unemployment, low payrolls, and economic weaknesses, then the Fed is going to be more dovish, meaning less restrictive, meaning they want the economy to thrive and they want to stimulate it. And so they want to bring interest rates down because when people have cheaper access to money through low interest rates, they tend to buy more, spend more, businesses take out more loans and expand and do all this different stuff. And so lower interest rates causes economic growth in a more profound way than higher interest rates, of course. And so if the economy is looking weak, the Fed will bring interest rates down. If they're more desperate to do it, they'll do something called quantitative easing, which is them going around printing money, buying up a bunch of bonds with it, and injecting liquidity into the economy in that regard. They did this in 2020 when we had the craziness of 2020. But the consequence of all that economic stimulus, like stimulus checks, supply chain restraints of 2020, and low interest rates is inflation. And so what did we see after 2020? We saw inflation spike. By 2022, it was almost 10%. The Fed has to be balanced, right? So they pivot to the other side, a more hawkish Fed, a Fed that wants to raise interest rates to push the economy down a little bit, because when people have less cheap access to money, they tend to spend less, inflation gets better. They can also do a more desperate thing. Like if inflation's at 10% in 2022, the Fed stepped in and they did quantitative tightening, which is reducing their balance sheet through letting their current balance sheet and bonds run off and mature. This restricts liquidity, pushes the economy down a little bit. And what they just said in the statement today is that they are going to slow down that quantitative tightening. They're still pausing interest rates, so they're leaving them unchanged. But now they are slowing down that QT. Again, the rate at which they are slowing it down is... They said, quote, beginning in April, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from 25 to 5 billion, 80% decrease. I got to change this song. I'm sorry. I can't do this. I'm sorry, guys. I can't. Okay. Yeah, again, beginning in April, the committee will slow the pace of declines of its securities by reducing the monthly redemption cap on Treasury securities from 25 to 5, 80% decrease. They'll maintain the monthly redemption cap on agency debt and agency MBS is at 35 billion. So they're slowing QT, but they're not stopping it completely, which is what a lot of people expected. And so, but it is a dovish action, meaning it helps interest rate. It stimulates the economy. By slowing QT, it in that regard kind of stimulates the economy a little bit more. And so you can see the bond yields decrease. Yeah, I can't do that. I can't do the music. I'm sorry. Yeah, I'm checking out the chat. How you guys doing? You guys red or green today? Let me know. Hey, Frankie Candles, my guy. Love the vibes of your stream, bro. Keep up the good work, and Powell's tie will be blue. It's never going to be blue, bro. I'm just telling you. I appreciate $100 dono from Frankie Candles. Y'all go check him out. He's actually a great crypto streamer. Y'all go subscribe to that man's channel. I see you streaming, bro. You're getting some pretty good numbers, too, dude. Go check him out. But thanks so much for the donation, brother. I appreciate it. Thanks so much. Again, I disagree, though. His tie is going to be like a light purple is what his tie is going to be. Powell's balanced here, okay? He can't go with a straight-up green tie. Market would love it. They would buy. He can't go with a red tie. That's too pessimistic. He's going to go with purple, a light purple in that is what I think. It's either going to be light purple or like a violet color, Wait, violet is light purple, isn't it? Hold on. Yeah, it's going to be like a violet, light purple, mauve. Is that right? Did I say it right? Apparently I can't spell it. It could also be like a rose color, but I think that's a little bit too pessimistic. But thanks for the donation, brother. I appreciate it, dude. Y'all go check out Frankie Candles. Yeah, market's green. Again, they're slowing QT down. That's a more dovish stance by the Fed. That's going to make the market like it. Again, you see bond yields decrease coming down. Lavender? Yeah. I mean, violet. Let me see. Yeah, it could be lavender. That's possible. It's gonna be purple. That's all I'm saying. Yeah, I mean, I'm not saying this FOMC release is dovish. What I'm saying is that the market has reacted to it in a dovish way. The market wants rate cuts. Market went up from this FOMC meeting. Bond yields decreased. That's a dovish response. So regardless of anything else, I'm just looking at the reactions here. I agree. I think we're kind of in stagflation territory as well, to be honest. And what stagflation is, I talked about this earlier. What stagflation is a period after we've raised rates to push economy down, where we have economic weakness as well as high inflation. It's called stagflation. It's a precursor to a recession. I kind of agree we're almost there. And I think they're also projected to see economic weakness over the next couple months. But in that regard, wouldn't that mean the Fed brings interest rates down? Wouldn't that mean the Fed combats the economic weakness through rate cuts, which is a dovish thing? No? I mean, we could speculate. It's all good. All right, guys. You guys ready? Yeah, so we can also see some other stuff too in conjunction with the FOMC meeting held on March 18th and 19th. So they submitted projections for most of the outcomes for GDP. Yeah. Inflation expectations are still a little skewed up. 2025, 2.6. December projections, 2.3% to 2.6%. Inflation expectations actually got a little bit better for 2025. 2026, they've gotten even better for that. Core PC inflation got a little bit better than originally expected as well. So are you guys ready? We're still waiting here, chat. Are you guys ready? I'm gonna put this up, and I'm gonna do this so that we got the earliest time frame here, guys. The earliest time frame. We got 3 minutes left. 3 minutes. And I'm also gonna do this so that we will put a different one up if we think that we need to. Okay, meaning. All right, and then we'll put some charts up to see what the market does ahead of this meeting. Here we got gold up here. And then we'll put a different one up. Let me fix this. I'm just gonna put the NASDAQ up here, to be honest. We'll put the NASDAQ up. Maybe we'll put like 10-year treasury yields up on the bottom chart as well. Sorry, I'm trying to get the stream ready here. Y'all can hear the music, correct? You should be able to pretty well. Let me get this out the way. Are you guys ready? Anyway, I'm gonna put a different one up too, just so we can I'm gonna mute the background music. We're gonna turn the music off here. And we're ready. We're gonna play this. All right, here we go. You guys ready? We're gonna turn the volume up all the way so you can hear it.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look much in the way of an increase, longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other? In
labor and inflation, just across the economy. Have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the pandemic.
You could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs, and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June. Was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. You know, it's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down, they tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
I'll do a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case there. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the Fomc have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
All right, guys, so that is it for Powell's conference today. There's a lot to talk about, so stick around. Look, number one, the NASDAQ is pumping up here. What happened to all the crash predictors, dude? They were so confident. They were wanting to bet on it and all this different stuff. Market's flying right now, honestly, from this Fed meeting. Market's flying. And again, it goes to show sometimes the market drops big on Fed meetings. It's definitely not going to happen every time. And if you try to shame somebody because you think the market is going to somehow drop big after every Fed meeting, you're probably pretty new to this. Market's ripped up. Again, I kind of agree with slowing QT down. The Fed is very balanced. You know, they're very balanced. They're not one to like want to be crazy or anything like that in terms of their decisions. They usually pick slow, steady, data-dependent, and balanced as their decision-making. So it's not a shock. Just to put this into perspective, just to break it down for a little bit here. Number one, before everybody leaves, check out our sponsor. If you want to learn to day trade, do not risk thousands of dollars of your own money. Almost all day traders lose. It makes no sense. Instead, try Top Step. They have a funded account program where they give you a demo. The base one's $50K. And if you can make $3K in profit on it without losing $2K first, a reasonable 3-to-2 ratio, they fund you $50K. They let you keep your first $10K in profit after that, and then 90% after that. If you fail, you only lose $50 basically. It's the best of both worlds. It's a 90% split, which is similar to funding your own account once you're funded, but much less risk at basically $50 a month for the base one. They have paid out almost $200 million in the last 4 years. They've been around for over 12 years. And if you use their native platform on top of all of this, you get zero commission. It's a great way to learn, and most day traders lose regardless of where they trade. It's just a great way to learn. Again, most day traders lose. Learning how to trade under structured environment like this with repetition. Trading is about learning how to trade and condition yourself to do the right things. And doing it on Top Step, most people are going to lose less money than if they fund their own account thousands of dollars and lose that. As well as it's going to teach them how to trade in the futures market. You can day trade the S&P, the NASDAQ, the Dow, the Russell, gold, some currencies. Patterns are very similar to blue chip stock patterns. I do this live every day. If you want to check them out, here is the link in the chat. Great way to help support the channel. Understand CFTC 4.41, hypothetical or simulated performance have limitations. I'm biased because they're an affiliate of mine. I get paid by them. But just incredibly useful, incredibly useful. Honestly, the market is ripped up from this report. Over 20,000. It did rebound a lot. Yeah, I mean, you guys heard me in December. I thought it was time for a correction. NASDAQ up 105%. You know, people acting like I'm only bullish just because I didn't necessarily think that we would crash from this FOMC meeting. That's not true. In December, late November, December, I told people I thought the market would correct. I said it over and over again. I probably said it at least 50 times, maybe at least 20 times from December to now. And, you know, it's not a shock. We got the last big correction over the last few weeks. The market generally corrects at least once a year, at least 10%. So it's not really a shock to see this correction. It was super extended, again, 105% over a 2-year period. Not really a shock to see it correct. It kind of needed it. Now, the big question is, do we continue down now after this Fed meeting, or do we start to rebound back up? You know, we're down 15% in the NQ. We're down like 11% in the S&P and the SPY and stuff like that. And so the market's still down a pretty significant amount. But they did react, favorably to this FOMC meeting. A couple things to talk about here around this, right? If you want to understand what this means, like you hear a lot of this reducing Treasury securities, MBSs, all this different stuff. Quantitative the Fed wants to control the interest rates in a balanced way. If the economy is weak, they'll bring interest rates down and they'll be dovish and they'll try to stimulate the economy. They can do QE, which is a form of money printing where they expand their balance sheet by buying up a bunch of bonds and then injecting liquidity into the economy. And this ultimately is a dovish thing, stimulates the economy, helps make the economy better. If the inflation is a fear, they'll do the opposite. They'll raise interest rates to push the economy down a little bit. And they can also do a more desperate measure, which is called quantitative tightening, which is where they reduce their balance sheet. They take liquidity away from those markets, and this pushes the economy down a little bit, helps push inflation down. It's a tool that they use to combat inflation specifically and push the economy down, because when less people spend, businesses lower prices. Now, a lot of people ahead of this meeting thought that they would do a straight up stop pause of QT. You know, this is passive QT. It's not direct QT. This is them letting their current holdings run off and mature. Direct QT is like selling bonds. This isn't that. This is passive QT. A lot of people thought they would do that. Instead, they decided to slow the decrease of their balance sheet, meaning they are dropping it down from a $25 billion cap in bonds, basically, down to a $5 billion cap, meaning they're reducing it by around 80% in the cap terms, but they're keeping their MBS reduction of their balance sheet the same. Now, what does this mean? Okay, so what does all this mean? When the Fed reduces its holding of MBSs, which is something they say they want to continue to do, maybe they're going to pause later, it puts upward pressure on interest rates and mortgage rates for a couple different reasons. When the Fed buys MBSs, it increases demand, driving up prices and lowering their yield, which influences mortgage rates. When the Fed reduces its MBS holdings, it decreases demand, which can lower prices and increase yields. Increase in yields tends to translate to higher mortgage rates. And so by them reducing it, it equals higher mortgage rates, increases yields, lowers the price of the underlying MBSs, and they're closely tied to mortgage rates. So when the Fed reduces its MBS holdings, it essentially is keeping mortgage rates higher, is what this means, right? So basically, the Fed, honestly, if we look deeper into it, the Fed likes treasuries over MBSs, right? So in terms of what they're reducing, they basically are saying here that they wanted to reduce their treasuries, or they want to slow the reduction of their treasuries and QT, but not their MBSs. So they still want to get MBSs off their books, essentially pushing mortgage rates higher and yields higher. But they are going to slow the reduction of their treasuries, is what this means. So I hope all that makes sense. Anyways, guys, like I said, we are green on the day. We had a pretty good day. And, yeah, honestly, it's been a little crazy today. We'll see if everything continues. Look at this big pullback here. Maybe I can buy this dip. I'll show you guys Top Step X here. Let's try to trade a little bit. We are up about $100 today, give or take about $100. Here's the NASDAQ. I'm going to maybe buy this dip a little bit here. Again, it's going to be a little scalping session. Let's play with it. Right, so we're going to start buying here. Very volatile, but that's okay. So you can see how similar this is to day trading stocks. We are day trading futures right now. Futures. If we dip a little bit more, we'll add down to maybe 7.5. I'd like the 20K level to hold here. I like attacking this 20K level. But again, you can see how similar it is to day trading stocks. These are micro contracts, which again, I can take with zero commission on Top Step X. Let's see if we bounce it all. We are down here. I did want to add to this. We got a cushion. Let's see if we can. Oof. I thought I had a. I have to go back and see how much I'm up here. But we're going to cut this probably right. I'll give it a second to get over it, but I'm not really liking this dip. That's better. I'll reduce some of the size here. 4 contracts now, and then wait. Make sure. I thought I had a different contract here. Let me. Oh, it's because I'm already green on the day. I have a 250 max loss on the day here, so we're down less than that now, but. Let's see if we get this pop, this bounce. Still got 4 contracts here. Looking a little better. All right, so we're going to take some off, protect it. And we'll sit on the rest a little bit longer here. There we go. Take half off there. Maybe add some to this too. We did get that bounce. And we took another piece off there, locked it out, and then we're kind of retracing back down some here. Yeah, that's turning too quick. So we're down a small amount on the day. We took our risk. You can see how similar this is to day trading stocks, though. So now we're under 20K here. The next level I have is 930s. Do I want to buy this dip too? I think I kind of do, but again, we're up a ton already. We're on like a 4 or 5 day green streak, so I don't want to give it too much risk. Here's a nice little bounce. I'm going to add to this. Here, we took half off there. Here we go. I'm going to add to this too. Took half off there. Nice. We'll hold the rest break even. We'll get out the rest there. So we actually got out the rest pretty flat. We'll see if we take some more size on this pullback here. I need to decrease down to here though. And again, I'm trading on Top Step's funded account program right now. I'm going to buy this dip now. Get them on Top Steps funded account program. I'll take another half off there. All right, we got out the rest there. Just made another $40. Scalping that. Doing okay. Grinding up. Attacking the sub 200 exponential moving average. Again, you can see how similar this is to day trading stocks. No PDT in futures. You can day trade the S&P, the Dow, the NASDAQ, the Russell, gold. Very similar to day trading stocks. People get it wrong. Like a lot of people attack Forex and there's so much red tape and they got to do like all this weird stuff, or they try to day trade stocks and they have to deposit like 20 or 30 grand. In the futures market, you can day trade a lot of this stuff. No PDT rule. Top Step's the most legit. They paid out almost $200 million. They give you a 50K demo and they test your skill. And again, most day traders lose regardless of where they go, including here. Frankly, it's a lot cheaper to lose here than it is to put up the money yourself and probably lose that. It's just a great way to learn, guys. A great way to learn. We'll stick around and day trade for a little bit longer. And again, there's no PDT in futures, right? So you can day trade the SPY and Q price action, basically. The SPY follows the S&P futures contract. The QQQ follows the NASDAQ futures contract, which is what you see me trading. I'm trading the micro contract. But Top Step is great because there's zero commission. I can take this little bitty size here and still net a majority of my profit. And if I fail, $50 to get started. So limited risk, similar reward, 90% split once you're funded. I'll put the link up one more time. And again, hit the subscribe button. Tomorrow, we got jobless claims, unemployment filings. So we got jobless claims, unemployment filings tomorrow. We're going to stream that data at 8:30 Eastern Standard Time. I'm going to buy this again and then maybe add to it. See if we can retrace up there quickly, but we can't get too deep here. All right, let's pop. There we go. See, we're running into my level though. There we go. All right, we took half off there. Gonna get out the rest there. We are now green on the day. I'm gonna go to shut it down. Effectively green on the day. We fought our way back to a green day. Listen, I love you all. I have a great day. You can see I'm green at the top here. Y'all have a great day. I'll see you guys next time. Again, jobless claims, unemployment filings tomorrow. I think we got some other stuff too. Yeah, we got jobless claims, the Philly Fed Index, existing home sales tomorrow, and then Friday is quad witching day. Y'all be careful. I love you all. Y'all have a great day. Remember, not an investment professional. I'm not liable if you lose money. Always make your own assessment. Trade responsibly. I have no freaking idea what I'm talking about. Might be wildly wrong about anything and everything I say. Understand, do not copy me. Sometimes I lose off stream and you're not going to see it. I don't even claim to be a good trader. Top 3 worst trader of all time ever in the world right here, signing out. Y'all be good. Again, be safe. Market is a little sketchy during FOMC. And yeah, I love you all. I hope you guys join us tomorrow. Jobless claims, unemployment. I'll see you guys then. Y'all be good.